Hello, and welcome to Spark Insights. My name is Jacob Blosky. I'm on the America's Primary Markets Business Development team for the London Stock Exchange. Our team is based in New York City, and we help companies from all across the Americas access high quality institutional capital um, by either doing an IPO or a cross listing on the London Stock Exchange. We're also very excited about the launch of our new private securities market, which allows for companies to stay private a bit longer while allowing their employees and early investors access to secondary liquidity. It's a privilege to be moderating today's panel. We're really going to get a full 360 view on everything IPO preparedness, everything from finance and legal structuring to corporate governance and investor communications, and just about everything in between. So really excited to be joined here by our esteemed panelists who are really going to walk us through kind of everything that companies should be prepared for and expecting as they embark on their ever so exciting IPO journey. So I'll let each of the panelists introduce themselves. And Lucy, you want to kick things off for us?
Thanks, Jacob. I'm Lucy Tarleton. I'm a director at CF Pro, part of BKL. We're BKL's specialist consultancy division, providing finance, accounting, and governance support to scaling and complex businesses that are undergoing significant change. And that change can be as stark as an IPO, or it could be rapid growth. We have a team of very experienced finance professionals who are embedded within a company's finance team and management team, working very much alongside the management team to help them achieve their end goals. We're very hands-on, we roll up our sleeves and are there to complete the journey from start to finish.
Thanks, Lucy. Sam?
Hi there, I'm Sam Cartwright. I'm a partner here at H Advisors Maitland, which is a global strategic communications consultancy. Here in London, I take responsibility for our financial and capital markets practice, which advises companies on everything from IPOs to M&A, shareholder activism, and other forms of financial communication.
Great. Tom?
Hi, I'm Tom Coulter, a corporate partner at the law firm Travers Smith. Travers Smith is a leading UK law firm which regularly advises issuers and investment banks on all legal aspects of IPOs and how best to prepare for IPOs and life as a public company. And that's one of the focuses of my practice.
Fantastic. So just real quick, before we begin, this webinar is being recorded. So if you want to rewatch it later on or pass a link to a colleague, it will be on demand on our Spark Insights website. We also want to make this as interactive a session as possible, so we encourage you to ask any questions that you might have on the right-hand side of your screen under the Ask a Question module. Those will be passed to me, and then I can pass them along to our panelists. So thank you for joining us today, and let's go ahead and get started. So Tom, the title of the webinar is Prepare, Prepare, Prepare. How far in advance do companies have to start preparing, and when do you see is a good time for companies to start?
Thanks, Jacob. Well, an IPO is an involved and detailed process, and becoming a publicly listed company means complying with regulatory, financial, and governance standards. So the better prepared companies are in advance of the execution phase of the process, generally the easier it becomes. In my view, whilst usually possible to do it in a shorter time period, a good time for companies to begin their IPO preparation is typically 12 to 24 months before the IPO date. And that will allow appropriate time to not only decide whether an IPO is the right liquidity event for your company, but it also leaves sufficient time to work on preparedness in advance of the transaction, rather than attempting to do so in flight. But undertaking remedial work mid-transaction risks delays, and missing the all-important windows in which to IPO. I think a company looking to IPO should be sufficiently ready to take full advantage of favourable market conditions, optimizing value and achieving a positive outcome for all its stakeholders. So we would always recommend preparing as early as possible, and that's certainly a fairly consistent reflection from most of the IPOs we've advised on as a firm.
Lucy, you wanna jump in there?
Yeah, I'd agree with Tom. We typically engage with companies in that 12 to 24 months window to help them get ready for an IPO, certainly from the finance perspective. There's a lot of the work streams are focused on the finances, so if you can start getting those into order, the sooner the better. It might sound excessive, sort of 2 years out, but actually the IPO is not all about the sort of regulatory documentation and the IPO itself, the transaction. It's also about preparing for being a public company thereafter. So it's switching that mindset from being the private company to adopting that public company mind shift.
Sam, anything to add from a comms perspective?
Yeah, sure. I'm not going to be the advisor on the call who disagrees that it's a good idea to start preparing early. From a communications perspective, there are a few reasons why it is a good idea to start to think about, what messages you want to land before the IPO launches. It's very sensible to do that. Chief among those reasons is freedom. When the IPO kicks off in earnest, publicity guidelines kick in, which greatly restricts what the company can say and what its spokespeople can say. And before that, there's much greater freedom. And as far as a year out, maybe even longer before the launch of the IPO, start to think about what you'd like people to understand about the company. What problem is it there to try and solve? What's the market opportunity? And what are the company's competitive advantages and its strategy for growth? Companies will often use this time to raise their profile externally in order to build understanding and appreciation of the company. There are numerous ways you can do this. One is, and this is sometimes called PLC Light, which is where private companies, potentially thinking about an IPO, release their financial results to the media in order to land key messages about the business, which support what will later be the investment case of the company. You can also share news flow, like major hires, contract wins, new clients, to show that positive momentum, and also providing commentary on themes that are connected to your company's investment case. It's also a good time to start to build relationships with the media. What you don't want is for the media to be learning about your business for the first time from the IPO, regulatory documentation. Much better to start that process early if you can. I mentioned freedom being one of the things that makes it sensible to start thinking about this stuff early. Another one is time. IPOs are an incredibly time-consuming endeavor for the leadership of a company and other people besides. In advance is the time to be thinking about what messages you want to get out there outside of the strict parameters of the IPO documentation.
Great, thank you. And so Lucy, from a finance perspective, when based on your experience, do you think is the optimal time for a company to IPO?
Well, given this is all about preparing for an IPO when they're ready, when they feel prepared, but I think there's a number of timing considerations to take into account here. From a company's perspective, I think it comes a natural step that an IPO might be consideration for a business when perhaps other private funding routes or private strategies are not appropriate, or it doesn't work for the business at that time. And secondly, there are things that are outside of a company's control, market conditions, for example. Currently, and recently, we've seen some unfavourable market conditions where the IPO market has been quiet. And it's only recently that that IPO window is tentatively being opened, where we're seeing and hearing companies preparing for an IPO, and that IPO pipeline is building. IPO windows can open and close pretty quickly. So those companies that are prepared and are ready to take advantage of the window when it's open are those that were more likely to have a successful IPO. Having said that, while the IPO markets are quiet and the IPO markets perhaps aren't as supportive for businesses to come to market, that's the time when businesses should be really thinking about the strategy and knuckling down on getting the business ready for any potential transaction in the future.
Sam, do you want to add anything to that?
Yeah, I mean, listen, I don't think your communications advisors are, the most important voices in the room when the timing of an IPO is being discussed. I'd only add that, taking the time to do some of the preparation work that we're going to spend this webinar talking about, will put your IPO in a place where it's got the greatest possible chance of success.
And Tom, from a legal perspective, what do you view as kind of the optimal time frame?
Yeah, I mean, I definitely agree with everything that Lucy and Sam have said. I mean, the optimal time for an IPO, so when a company is most likely to achieve a successful public listing, really depends on a combination of internal business factors and external market conditions. So, an IPO can be a great way of raising capital and expand. It can be a way for the company's founders to partially or fully exit the business and capitalize on the success of a company they've set up, and also provide increased visibility and awareness of the company due to the publicity of the IPO process. And investors are typically looking for companies that can demonstrate strong, consistent financial performance, an attractive market opportunity, and a compelling story of both current and future potential. But balanced with that is, as Lucy mentioned, the landscape for IPOs is dynamic and is influenced by macroeconomic and geopolitical factors, as we've seen over the past few years, making it difficult to predict the perfect moment to list, with windows of opportunity opening and closing. But I think that it's really important to find a window that works for your company rather than necessarily the market, which can change quickly. And the company just needs to be ready to act within that window when the conditions are favourable.
Great. So let's kind of look at sort of what are best practices. Lucy, I don't know, from a finance perspective, what do you feel are kind of best practices that companies really should follow as they embark on their IPO journey?
Thanks, Jacob. One of the first things that we recommend companies to do is to undertake an IPO readiness assessment. So thinking and looking at all the different areas of the business that might be impacted by the IPO and being a public company. So an IPO readiness assessment is usually conducted via a series of workshops and meetings with the finance team and the management team. It's really assessing sort of what procedures, what processes are in place around preparing financial information, reporting financial information, the governance procedures that are in place, the corporate governance disciplines that are in the company currently, and how big is that gap between sort of the status quo now and going to be a public company, and working out what needs to be done when and how in the meantime. So typically after these series of workshops and meetings with key management and members of the finance team, the company will be provided with a report identifying those key areas and actions that need to be remedied before the IPO, what can be delayed a bit and wait until after the IPO, who is going to be responsible for those actions are also prioritised, and also the timing and how long things might take. So typically what we see from a finance perspective is the financial accounts need to be presented under IFRS for a public IPO. So being able to convert the existing accounts into that can take some time, particularly when you have to go back historically, potentially 3 years or 4. So the IPO readiness assessment is actually also quite closely linked with one of the other financial work streams, the Financial Position and Prospects Procedures report, the FPPP, to save me having to say all that again. And this is something that for a main market IPO, the board of directors have to state that they have the proper procedures and policies in place to be able to make these judgments around their financial prospects and procedures, i.e. their financial position and their profitability and cash flows as a public company. The sponsor on an IPO will then also have to declare to the FCA that the company indeed does have these procedures in place, and the reporting accountant, usually the company's auditor or the firm of accountants working with the business on their IPO, will then also typically prepare a report commenting on the financial reporting procedures that are in place. So I've talked a bit about the IPO readiness assessment, looking at the sort of the financials, but equally it's an area that is the IPO assessment looks at the wider areas of the business, so the tax and the legal structuring, which perhaps Tom can comment on, ESG, investor communications, investor relations, also looking at people, reward and remuneration. So it's not just looking at the numbers and what needs to be produced for the IPO, but really assessing how ready you are to transform into a public company.
Thanks. And Tom, do you want to jump in from a legal perspective, kind of what the best practice would be for legal structuring?
Sure. I mean, agreed that I think a robust IPO readiness assessment is often the first step in a successful IPO, carried out by a combination of advisors, including lawyers, and really carrying out a kind of structured, holistic process that benchmarks the company against public company standards, highlights gaps, and creates a concrete plan to close them out. From a legal perspective, this will help companies carry out some initial key structuring considerations. So how best to structure the group at listing from both a tax and legal basis, including the top company of the group, doing some analysis on its current governance and reporting structures, and where it needs to be in those areas as a public company. And I think really importantly, it's carrying out due diligence on the company early, identifying material issues early so that they can ideally be fixed before the sort of execution phase of the IPO, or at least have sufficient time to consider how they could be adequately disclosed to the market in the prospectus on listing. And that should really help minimize delays to the timetable and reduce issues that could impact valuation during an IPO process. Because what you don't want is material issues arising or being identified late in the process. This forward planning should also help management understand what needs to be done early and ensure that they have sufficient internal and external resources to support them through the process. So as Sam mentioned earlier, the execution phase of the IPO is a busy time for management. So it's really good to do this IPO readiness assessment early ahead of them.
And Sam, anything you want to add from a comms perspective in terms of best practices?
Yeah, sure. I mean, I think we covered some of what constitutes best practice from a comms perspective at the top of the agenda, but we did miss a few things. And I say the three I want to cover now up top, so I don't forget them. One, thinking about your own channels and what they're doing for you. Second one, readying your spokespeople. And the third one is readying a leak strategy. So just going into each of those quickly in turn. When people talk about your own channels, this is a reference to that which you publish about yourself. And the preparation phase is really the time to be thinking about whether those channels are helping you to tell the company's story and whether they're optimized for the audiences you're trying to reach. So the obvious one is your company website. It should be a home for engaging content that enables people to understand your company, its track record, and its competitive strengths. There's also your social channels. That's everything from LinkedIn to more video-based content. Obviously you don't need to be on all of them, but you do need to be thinking about what the right strategy is for each of those channels, looking at not just your company, but also the leadership and employees. Are these channels, are they doing what they need to in order to help you tell the story that you want to tell and to show momentum? But equally, from a risk perspective, you need to make sure that you've got the right processes in place, that you're avoiding risks of those channels being used ill-advisedly. So that's your own channels. When it comes to media training, this is for anyone who might be speaking on behalf of the company. So thinking particularly about your chief executive and your CFO, putting them through multi-channel media training well in advance so that they feel equipped for the much greater publicity that the process will bring for the company, and also to handle any challenges. A leak is a challenge that you might face. And really leaks are, a very plausible scenario for any company considering an IPO. Now, a leak strategy is not a strategy to stop leaks from happening. Rather, it's a plan to make sure that if they do happen, you're able to manage them. So firstly, if the media runs a story about your company, considering an IPO or working towards an IPO, it's important that that media coverage doesn't tell an unhelpful story about the company, the vendors, and perhaps their motivations. So you need to be clear on what messages that early coverage needs to contain. And secondly, when that coverage lands, what are the executive leadership going to say to other stakeholder groups? So, for example, your employees, customers and partners, to make sure that they're not unsettled by that speculation or that news, and they can continue the business as usual operations of the company. These are questions that you need to think about in advance and well ahead of needing them.
Definitely very important. Thank you. So now shifting over to kind of what we want to avoid. What are the common mistakes that companies make during their IPO prep? Tom, you want to start us off there?
Sure. So I think it's worth reiterating that the risk of issues arising during the process should be significantly reduced by early planning. But a few common pitfalls we see are, firstly, an IPO process places significant demands on management's time. A company really should consider internal resource capacity and capability alongside its advisors well in advance of starting an IPO process, really to ensure that the business can operate on a business as usual basis when the transaction really gets going. So resource planning will identify gaps, allow time for a company to appoint key personnel to run the internal IPO process, and be responsible for key areas such as financial reporting without hopefully impacting running the business. I think another area is having the IPO board appointed and engaged early in the process, which is key, and that will ensure they have an opportunity to be involved in all work streams from early on. It's always much harder to try to address material comments or issues from new board members on matters such as disclosure, equity story, or governance later in the IPO process. I'm sure Lucy will come on to this, but ensuring that the appropriate financial controls and reporting lines are in place well ahead of IPO, so everyone can be comfortable the company has adequate internal controls and will be able to satisfy financial reporting requirements post IPO is key. Often a company will move quickly on from closing an IPO to first financial reporting as a listed company, so it really needs to be ready for that. And finally, due diligence issues, as I mentioned earlier, if those are identified later in the process, that can cause delays or impact valuation, which could have been addressed as part of a pre-IPO readiness. So prepare.
Sam, how about from a communications perspective? What kind of mistakes do you see companies make often?
Sure, I seem to be doing things in three, so I'm going to do three again here. I think everyone who's advised on IPOs or worked on IPOs is aware that they'll have worked on ones where they haven't actually got to the starting line, and others will have advised on IPOs that have got to the starting line and haven't got to the finish line. And I think that's really important context to remember when deciding how open to be really about your plans, with stakeholders, and particularly your internal stakeholders. So that's mistake number one. Second, I think a common mistake is the sort of starting point that companies feel their audience has about the company. I think it's a common mistake to really expect too much knowledge really about the market in which the company operates and the company's role within that. No one's ever been told as feedback that their message is too simple. So simple stories with clear messages and minimal jargon, they're really the most compelling. Whether you're talking to a generalist investor who's considering a whole universe of investment opportunities, or a veteran sector analyst, keep it simple. And then the third one is obviously there are lots of rules and regulations around what you can say through an IPO process. But I think it's really important that people don't interpret that as meaning that it's, that they really shouldn't say anything at all beyond what's regulatory, required from in a kind of, from a regulatory perspective. There are many ways of communicating effectively and creatively through an IPO process while staying the right side of the rules. And you'll need to do that in order to maximize your IPO's chance of success. That's my three.
Great, thank you. And Lucy, from the finance side of things, what kind of mistakes do you see companies making?
Yeah, I think I agree with everything that Tom and Sam have said, but certainly the sort of inadequate planning and preparation. If companies are rushing the process, or they get to it and issues are coming out of the woodwork that need much more time than thought to address, then there's potential delay to the IPO timeline. Equally, certainly a lack of resource or experience and capacity within not just the finance team, but the management team, having not sort of underestimated the task at hand. So bringing in that sort of additional resource sooner rather than later can help avoid some of the pitfalls that we see. Equally, sort of linked to that, particularly around finances, and sometimes some of the communication too, is perhaps during the IPO process over-promising, and then once coming to producing that first set of results, then you're under-delivering. And so it's a very difficult position to recover from, where you have to sort of get back up to sort of meet those investor expectations. So those will be my things that I'd add just to what's already been said.
Thank you. And we'll stick with you. I mean, an IPO requires, a few different work streams. It can be a strain on some management teams. How do you think a business can maintain business as usual throughout the process and maintain, everyday activities?
Yeah, it's absolutely fundamental that the business understands that an IPO is quite a fundamental task and transformation of the business, and will require a lot of management's time away from the day-to-day. So they've already touched on in the previous discussion, assessing the internal resource capacity in the team is absolutely essential to understand sort of who's going to be responsible for what. So a lot of companies will dedicate somebody from within the company as their sort of IPO project manager, who will support the CEO, the CFO, the rest of the board throughout the process, coordinating with advisors, helping with the data management, because there will be a lot of information requested from advisors, coordinating all party calls, etc. Really sort of having a steer on how the transaction is going. It's not just internal resource can provide that. There are a number of people, including ourselves, who can undertake that role, and a number of companies do appoint an external IPO project manager to undertake that, given that they have the experience of going through this before on the company side. They can look around corners, they can see what's coming down the line, they can help respond to information requests from various advisors, and help sort of educate the client as they're going through this process in terms of how long things need to take, what needs to be prioritised, etc. It can be, well, it is all-encompassing, an IPO, but it shouldn't actually distract management's time from looking at KPIs, looking at the revenue that's coming in, because ultimately they need to be focusing on the business during the process, because they've got to have a business at the end to float. What you don't want to be in, sort of as I alluded to before, is when you get to that first set of results, disappointing the investors that you've been talking to throughout the roadshow.
Thank you. And so now I'll shift over to Sam. from the comm side of things, what kind of, objectives need to be met before the IPO? And then, Tom, I'll ask you to jump in too. I know we've touched on it a little bit, but, kind of what kind of publicity guidelines do companies have to adhere to prior to the IPO while still meeting, the objectives that they want?
Okay, so I'll go first. I think from an external communications perspective, a lot of the effort is going to be focused on building visibility and understanding of the company. And this is all to create the right context for the company to effectively communicate its equity story when the IPO launches. The goal is to make sure that prospective investors understand the company's value proposition, growth drivers, competitive advantages, and long-term strategy. Remember, investors, they're buying management teams. And so building the team's credibility and recognition for its track record is a related objective. And that's thinking about the external. On the internal side, we've said already that an IPO can be an unsettling period for employees and also for customers and partners. Good communications will reassure these stakeholders and minimize the disruption that the process could cause. And then the third one, I keep doing things in threes. The third one, the communication strategy should seek to maintain the company's options and make sure there's as little reputation damage to the company as possible if the company and its shareholders ultimately decide upon another course of action.
Tom, you want to kind of discuss the guidelines that companies need to follow when it comes to
Yeah, so as the company's lawyers, we would prepare written publicity guidelines, which are usually circulated at the earliest stages of the IPO process, to both directors and employees of the company and the wider advisor group. And these guidelines would outline legal restrictions on publicity and communications during the IPO process, and really just try to ensure that all communications about the IPO are factual, non-promotional, and routed through formal approved channels, primarily the prospectus or the official IPO marketing process, but while also not preventing the company from making business as usual communications so that the IPO doesn't impact its business. Breaching the publicity rules can impact the offering, cause certain regulatory issues, or expose the company and directors to liability. So we work closely with advisors such as Sam's team to carefully guide companies on their public relations and advertising activities during the process, really to ensure a smooth communications and wider IPO process.
Excellent. And so, obviously plenty of benefits of doing an IPO and being a public company. But of course, some things, do change a little bit for the company. So kind of how does life change for the company after going public, and what can companies do to be best prepared? I guess Sam, we'll start with you on that.
Sure, we could spend a whole hour or even longer talking about this, but maybe just a few sort of starting points. One of the benefits of an IPO is the visibility and profile that listed PLCs enjoy, and I've had clients citing that as one of the key motivations for floating. But with that listed status comes greater scrutiny and a compulsion to communicate frequently and transparently. Once the company shares are admitted to trading, a whole host of rules and guidelines apply, which dictate what the company says, how it says it, who it says it to. So that is one way that things change, very much once the flotation is done. Post IPO and really to sort of, in acknowledgement of that new status, the company will need to follow a multi-stakeholder engagement strategy, and that engages with stakeholders that weren't really, on that company's radar as a private company. So that's, yes, it's investors, but it's also sell-side analysts, and it's the financial and business media. And a good communication strategy won't just, consider those announcements that a listed company needs to make, but also how to maximize the time in between the financial calendar in order to continue to build understanding and appreciation of the company and reinforce that investment case. And there are all sorts of ways that can be done.
Lucy, you want to chime in from a finance perspective?
Yeah, I think from a finance perspective, it's the regulatory compliance that companies will notice that will step up being a public company. Certainly quite soon after the IPO date, it'll either be the interim reporting date or the year-end reporting date, which will be the first test for the company to put in practice the policies, procedures that they've said that they would do as a public company to get their numbers, their accounts out on time. So they might have said, well, this is how we're going to do it, but it will be a true test to actually get them to do it. There's also the corporate governance that companies will need to comply or explain with, the UK Corporate Governance Code for main market companies, or the QCA, Quoted Companies Alliance corporate governance guidelines for smaller AIM companies. Sort of abiding by those, again, regulatory and compliance restrictions can potentially also hamper the sort of culture, the entrepreneurial culture that may be within the business as it was a private company. However, having said that, the public markets are a great place to access that ongoing capital. You get the raised profile with various stakeholders, your customers, suppliers. You can use shares for acquisition currency. And you can also incentivize your staff with equity. So there's lots of benefits from being a public company, as well as some of the other considerations that businesses would need to take into account.
Tom, you wanna add some things on the legal side?
Sure. Yeah, and agree with all those benefits. So I think from a legal perspective, one of the key areas for life as a listed company is that a company will obviously be under much more legal disclosure and reporting obligations as a public company compared to private. So part of it is just making sure it has the right policies, corporate governance, internal controls and procedures in place early on, and has received the right training, both to kind of board and employees ahead of listing, so that it can stand up and satisfy its disclosure and regulatory obligations as a listed company. And having adequate systems, processes and controls should minimize the burden and increase investor confidence. So should all of that IPO prep should then help as a listed company. And the rules and the guidance are constantly evolving. So staying on top of future developments with support from experienced advisors will really support a highly effective reporting function as a public company.
Great, thank you. And so, Sam, obviously, one of the most important parts of being a public company is speaking with investors and, demonstrating your company's equity value, right? So walk us through kind of, what makes a compelling equity story, what is an equity story, and, how can companies prepare to have one once public?
Sure, I suppose that's the $1 million question, really, or I should say million pound question, given this is a London Stock Exchange. There are many ways that you could answer that question. And the process of building the equity story is one which many different advisors will participate in, with communications really just being one of those. A key role of the communications function, by the way, when it comes to the equity story, as well as being involved in its creation, is helping it to bring it to life. Using things like video, infographics, fact sheets, and other storytelling devices to really, as I say, bring it to life. But a few thoughts on what the equity story needs to do. First off, what's the market you operate in? How big is it? What's its growth rate and growth potential, and what's driving that growth? So that's the market. Then within that context, what's the company's business model and its strategy to exploit that market opportunity? How is the company competitively advantaged to win in this market? Is it its tech? Is it its customer relationships, network effects, cost advantages, or is it perhaps barriers to entry that stop others from competing? Third, what's the track record that you can point to show that the company's model and its strategy are ones capable of delivering sustainable, profitable growth. And related to that, being able to show resilience through the cycle, showing how the business performs in different market conditions, that will also be important. And the final one I'll highlight is, again, back to this point that investors back management teams. What's the experience and track record of the leadership team that you can point to? That's a really important component, as is being able to demonstrate an alignment of interest between that executive leadership and shareholders. Now, there's no one formula that fits every situation, and companies will emphasize different things in order to stand out. But I think they are some of the key things that every good equity story will address.
Great, thanks, Sam. So now let's kind of compare and contrast, IPOs versus other exit strategies that companies, might be considering. How does the IPO process differ from, let's say a sale to PE or, any other sort of M&A? Lucy, do you want to take that from a finance perspective?
I can certainly start. So obviously we've been discussing sort of preparing for an IPO here and given our hosts the stock exchange. But there are obviously other routes to market that companies could take, whether it's a trade sale, whether it's a sale to private equity or dual track. And each one of them has their own different dynamics, benefits, challenges. It very much does depend on what the company's end objective is. So, I mean, the key areas that would differ under these processes would be the transfer of ownership. So who's going to be the buyer of the business? Is it going to be the public markets? Is it going to be private equity? Is it going to be another strategic buyer? And looking at sort of the mechanics of how you get there, and particularly around sort of how that exit is structured for a founder of a business. For example, is it a full exit or a partial exit? An IPO allows a partial exit, whereas, for example, a sale to a strategic buyer would likely be a full sale. So looking at the dynamics around that and what are the actual end goals. Obviously, with an IPO, the key's in the name, it is public. Sales to private equity, a trade sale, a lot of the negotiations will be done privately. There's a lot being discussed around the various work streams, whether it's the legal, whether it's the finance, whether it's the communications, getting the equity story right. Looking at the sort of the regulatory cost and the process that's involved to get the company onto the market and the number of advisors involved. Given that, an IPO can potentially take longer and potentially could cost more than a trade sale or a sale to private equity. However, all these types of transactions we've discussed, they are events, significant events in a company's business life cycle. All of them require preparation. It just really depends on the process that the company is prepared to go through and what they're ultimately aiming to achieve at the end of it.
Great. Tom, you want to compare and contrast on the legal side?
Sure. I mean, agreed that many of the disciplines around IPO preparedness, so financial reporting, management information, board composition, will also prepare a company for different types of liquidity events, such as a sale process to PE or a trade buyer. And all of those exits typically involve an extensive due diligence exercise, which drives disclosure of all material information to the buyer in an M&A context or investors in an IPO context. IPOs obviously involve building public company infrastructure, the governance, reporting. There is a regulatory approval process, investor roadshows, and full public disclosure. So, as Lucy alluded to, it can sometimes take longer, not always. Can be more resource intensive than an M&A transaction, but every company is different. Founders and boards should carefully weigh up their goals, the company's market position, growth prospects, and shareholder needs when choosing between an IPO and M&A, or whether pursuing a multi-track approach where a company simultaneously engage in trade, PE, and IPO processes, which might be the right approach to drive the best outcome for shareholders.
Sam, anything you want to add from a comms perspective?
Yeah, sure. It's just one. I mean, from a communications perspective, the big difference between a private sale, whether that's trade or PE, and an IP, how much you choose to say about the process will be a decision for the parties involved in a private sale. Now, there may well be disclosure obligations if the buyer is itself listed, but if that's not the case, then really how much you say, about the deal, certainly pre-announcement, is up to you. Whereas obviously with an IPO, the communications timetable and the requirements are very tightly prescribed. I'd say that's the biggest difference. But as has been said already, lots of similarities.
Perfect. Thanks, Sam. So, just taking a high level look at things, what final piece of advice do you have for companies who are navigating the IPO journey or thinking about pursuing it? Lucy, we'll start with you.
I'd say start preparing early, but think long term. I think the earlier you start, the more control you have over the process, your valuation, the timing, and the messaging.
And Tom, you want to jump in?
Yeah, so it's similar for me, really. I think get prepared and identify and fix any issues early. Work with your advisors to make sure you have the right teams in place early on, both externally and internally, so that you can deliver a smooth IPO process and really hit the ground running as a listed company, and make sure to focus on being ready for the listed company life as much as the IPO process itself.
Sam?
Well, I can't say start early because I'd be the third person to say it, although it's definitely true. The only other one I'd add is, keep it simple. Back to what we were discussing before, simple messages work best. Make it easy to understand. Make your story easy to understand to a generalist.
Great, thank you. So we're getting some questions from the audience. So give me a moment here. So the first question is probably for Lucy and Tom. What would you say the average time frame from starting to actual listing would be, all things included?
Well, as mentioned earlier, and it's a good question. We would usually recommend to prepare early, which could be 12 to 24 months out from the IPO closing date. And in that pre-IPO prep stage, a company would get its house in order, so strengthen internal controls, enhance infrastructure, appoint advisors, work on other financial and other issues that could affect the IPO. And then move on to the execution phase of the IPO, which would typically take 5 to 12 months, including carrying out the DD exercise, preparing the prospectus or admission document, the marketing and roadshow, all the way through to pricing. So, as in summary, I think it would usually take 12 to 24 months in total if you're really preparing. Although obviously you do see IPOs that are done on much shorter timelines, depending on the level of prep work carried out and the circumstances.
Lucy, you want to jump in there?
I don't really have anything to add to what Tom's just said. I echo it all.
Okay, all right. So Sam, this one's for you. Beyond disclosure, how should companies shape their narrative so investors, media, and policymakers see them as credible and investable, especially with today's ESG and governance scrutiny?
Yeah, I think it comes back to something that we talked about earlier, which is, starting to behave and communicate like a PLC well in advance. Establishing those practices and those behaviors in advance will definitely go a long way to sort of building that credibility externally. So that really by the time you're entering the IPO phase beginning in earnest, you're already acting like a listed PLC. So I think that's part one. Part two, thinking about what you want your board to look like, making sure that you've got the right kind of blend of experience and expertise, including people that have done it before with listed PLCs. I think that's really important. I think the question said something about taking into account ESG. I think increasingly ESG is obviously it's important, but very often now ESG is something that needs to be kind of woven into the whole story. So I think it wasn't long ago that you'd sort of have a separate section in the investor material saying this is our ESG policy and strategy. Increasingly now you see it as something that's woven into all of the company's communications. And I think when it comes to ESG, it's important to be authentic. Not just to be, ticking the boxes that you think need ticking, but, focusing on those things that are, particularly relevant for your business. It's
Great.
a
Thanks,
whole
Sam.
other topic though. So, another webinar, topic for another webinar, perhaps.
Sounds good. I think, Tom, this probably comes to you. What legal or regulatory changes should companies be aware of in 2025 that might impact their IPO readiness?
I think one of the, as a number of people will know, in the UK, there has been a number of kind of regulatory changes with the UK markets to try and make it more dynamic and flexible as a market, and to encourage more listings, but also more flexibility as a listed company, and that includes flexibility when listed companies are making acquisitions. There's the new prospectus rules coming in early next year, which give further flexibility, for example, on the level of shares a company can issue without a prospectus. So there's been a number of legal and regulatory changes, particularly the listing rule reforms and the new prospectus rules, which should drive growth in terms of kind of IPOs and make it easier as a sort of public listed company.
Lucy, was there anything that you wanted to add there?
No, not from my side.
All right. So I guess what are the most important qualities that investors look for in a management team during an IPO roadshow? That can probably all of you can probably weigh in on some aspect of that. Sam, should we start with you?
Yeah, I mean, I think it's definitely an important question. How do you build that credibility for the management team? A lot of it is track record. Whether that's with the company that's considering IPO or previous experience. So that's a big one. I'll let the others chip in if there are any other aspects that I think are important.
Lucy, you have anything?
Yeah, I think echo the sort of credibility, and I think if they have undertaken that sort of IPO readiness assessment, that they've actually delegated, they've freed up the resource so that they can dedicate the time to focusing on the important parts of the IPO, but equally keep an eye on the business too. And actually having the team is not just about the CEO, an individual, it's the whole team, the sort of executive team and the board.
Tom, anything to add?
Yeah, I'd echo all that. I think having an experienced board is very helpful, who can show, I guess, the growth journey and addressable market to investors, and are clearly all over the financials, and I guess able to articulate the equity story of the company very well, consistently across a number of investor meetings.
Great. And we got one question that might be putting you guys on the spot a little bit, but can any of the panelists share an example of a company that navigated the IPO process particularly well, and what lessons can be learned from their experience? So if anyone wants to start on that, I'll let you.
I think certainly in my experience, without naming any that I've specifically that I've worked on, one of the areas that has created a smooth IPO process is engaging early, where there have been issues from sometimes a regulatory or legal or financial perspective that would have a material impact on the IPO. But by getting advisors in there early, we were able to resolve those and then actually create quite a smooth IPO process. So I think that's certainly in my experience one of the kind of big areas where readiness has really added value. And then actually when you go to the IPO process, when you're engaging with investors, all of that goes a lot more, and working on the disclosure, that goes a lot more smoothly.
Yeah, again, I probably won't give one specific example. It's too tempting to to pick a client. So rather than do that, I'll just say that the story that you tell at IPO, if you're still telling that same story, into the medium and long term, that's a good sign that that it was a successful IPO. An unsuccessful IPO, or one measure of it, is where shortly after IPO you're sort of pivoting and telling a different story. So I think that's a really important part. Think about the investment case that you build at IPO. It needs to be durable. It needs to see you through the coming years.
Lucy, anything to add?
Yeah, and just to add to what Tom and Sam have said, is that I think a company that's acting like a public company before it does an IPO makes the whole transition to being a public company a lot smoother, and also aids the IPO process.
Fantastic. And Sam, I'll start with you on this one. How can companies maintain strong relationships with their new shareholders post IPO?
Yeah, I mean it's a really important question, and there are lots of different ways that you can do it. I mean the first point is is have a plan in order to do it. Have a plan for how you're going to engage frequently with your top 10, but not just your top 10, also prospectives. You might do that through capital markets events, not immediately after the IPO, but as well as communicating around your results, having very often companies look at doing a series of capital markets events. So historically, it might have been one big capital markets day, which is covering the whole strategy, the whole business, and they're really resource intensive processes, and they still happen. But a way that's increasingly common now is to look at a different part of the business at separate occasions. So you might do 4 or 5 events over an 18-month to sort of show investors different aspects of the strategy, but also introduce them to other members of the management team, not just the CEO and the CFO that they might see on results days. And also keeping in touch with dinner events, fireside chats, that kind of thing. Just really being proactive, considered, and transparent in all of your dealings with your shareholder base.
Excellent. Thanks, Sam. Tom, Lucy, anything you want to jam in there for the last minute or so? No? Okay. Well, I think that does it for the questions that were submitted. Sam, Tom, Lucy, thank you so much for joining us and providing your insights. And thank you to the audience for joining us today.